Welcome back to the Raw Selection Private Equity Podcast. Joining us today is Chris Rozzell, Managing Partner at Cresta, a private equity firm in the US focused on the infrastructure sector. We're going to dive into lots of different elements today. One's going to be infrastructure. One's going to be his journey from portfolio executive, growing a business to billions in valuation, and then starting his own firm. We're going to dive into the LP return, decarbonization, and even put a hopeful end to the conversation around ESG. But let's dive in, and thanks for coming on the podcast, Chris. Chris, if you can share a brief insight into you, please.
Yeah, sure. So out of college, I started my career in investment banking, which I think is pretty common in private equity. I did that for a couple of years. It really didn't stick. It wasn't really the right fit for me. So after that analyst program, I went into the power sector for a little while. I was there for 5 years. Did a little bit more of a leadership training program there. Strategy was in the trading part of the business, risk. So learned a lot about how power works sort of from top to bottom. And then I would say my career really started around 7 years after college when I joined a startup called Regency Energy Partners, which was private equity backed, small business with the idea of building out energy midstream assets. So transportation, storage, processing around various gases. And so that business, we went from startup to ultimately going public, and then grew it to several billion in enterprise value, and then sold it to a large competitor. And so I kind of view that. And along the way, I became the chief commercial officer of that business, having started as effectively an analyst. And so I view that as a real masterclass in taking a business from that initial private equity investment all the way through exit. So I met two of my founding partners at Regency. We've worked together now for 20 years. And the three of us, after we sold that business, decided to start a second business doing the same thing. That was another success. And then ultimately we launched Cresta, which is our private equity firm.
Congratulations to you on that journey. It's not common to see people go from investment banking into a portfolio world and then into investing. That's quite unusual. What did you glean from that journey? What was that? What are you taking now and being like, God, I was so glad to have gone through that process with regards to actually being in that portfolio, taking it, scaling, working in a startup, right through to a $1 billion valued company, then doing it again?
Yeah, I think there's a lot that yeah, as a private equity investor, there are some very specific things that private equity investors need to understand, right? You have fiduciary obligations, you've got these sort of compliance you have to stick with, but most of what we have to do really well, I think you can learn best in the trenches of a company, right? You learn how to build a leadership team. You learn how to build out management systems. You learn how to communicate. There's a lot of things that in transactional businesses like investment banking, I think there's a less focus on building out internal communication, learning how to become you see this in consulting. A lot of people in consulting are really great storytellers, right? They're really good at distilling down a message and making it very easy to digest. But I don't think that's quite as common in some of the more hardcore finance fields. And so I learned most of that really in the industry side, learned how to take a complex story and really digest it down to the parts that make the most sense and that we need to focus on the most. So I think just being also a business that had lots of boots on the ground, we were actually out in the field building things from scratch, learned a lot about just the process of development and construction. So, permitting, contracting, actually mobilizing a construction force, right? So a lot of those things have translated into what we do today in a way that I don't think I could have picked up sitting in an office the whole time. So,
How have you found in comparison with building a portfolio company to building a private equity firm?
yeah, I think the biggest challenge, and I've talked about this with some of our investors as well, when you are in the middle of the portfolio company. I was a chief commercial officer, so my business is mostly interfacing with customers, but you get a chance to actually look the customer in the eye. You can hear what they're saying, but you can hear what they're not saying too, right? You can get their body language. You can notice that they're sweating a little bit, they're avoiding eye contact. There's just a lot of cues that I think plugs you into the real, day-to-day pulse of that industry, in a way that as a private equity investor, you're just one step removed. Today, what I'm hearing is the portfolio management or the portfolio company management team giving their color version of that meeting, but the play-by-play is lost, right? I wasn't there. I didn't actually get to see it. And so what we've learned is that there's a huge value in building trust, right? In building trust with the management teams that I think as a management team ourselves, I didn't appreciate that as much, but being on
Hmm.
the other side of that, I really appreciate that. We need to have that trust with the teams. The communication has to be rock solid, and we really can't be in a position to lose anything in the translation. So.
Perfect. So what's one mistake that you see private equity firms or equally portfolio companies making, and what would you suggest to correct them?
Yeah, I think from the firm side, at least where we are in more real assets, we invest in heavy, industrial businesses. One of the mistakes I think that I've seen, and I think I understand why, but is that a lot of firms in infrastructure, real assets, really avoid anything to do with earlier stage investing. If you look in the venture capital world, there's a lot of founder mentality in venture capital. I think many of the top VC firms are populated throughout by former founders. And you really just don't see that in infrastructure, really in private equity in general, but certainly on the more heavy asset side of infrastructure. And I think that's a mistake because I think there's so much alpha to be found in that earlier stage of growing out infrastructure so that it becomes plug and play for, the bigger, either strategic or the large infrastructure aggregator. And the way we've addressed that is multifold, right? I think part of the reason why you don't see it as common is it's a high touch part of the business. It takes a lot of time and attention. And by definition, it's a little bit on the smaller scale, right? We're actually investing in earlier stage before this company is maximized. And so you're talking about smaller dollars with a lot more time and attention. That's not necessarily the model that drives bottom line for a lot of the bigger firms. But the way we've addressed that is multifold. One, we have a lot of founders in-house, right? Obviously, we have four partners today. Three of those, we all work together as founders, and the fourth actually had most of his career in industry as well. He spent a lot of time, this is John Skriner, at very large multinational trading firms like Glencore and Gunvor and Noble, building out supply chains and a lot of development expertise. So we have a lot of that corporate or development expertise in-house. I think another thing that we've done is having been a founder a couple of times, we have a pretty good idea of what the challenges that founders face are. And so we built a services business called Cresta Fund Services that effectively provides back office support for earlier stage companies. So we have in-house accounting, in-house legal, we have in-house HR. So we have all of these components that can be a little bit daunting if you've been in a bigger company and you're sort of launching as a startup for the first time, things you didn't really think about when you're laying out your business plan. And so that's another big part of it. So you really have to approach that part of the business all in. You can't dabble in that part of the business. And I think that's what's burned people before. They might do a one-off development here or there, and then find themselves sort of ill-equipped to manage the things that can pop up from that. So I think the way to address it, again, the mistake is ignoring that part of the business, that earlier stage development. The correction is really going all in and trying to address the common problems that arise in development and seeing it as a specialty line of business you want to focus on.
Perfect. Not only am I the host of the Private Equity Podcast, but I'm also the founder and managing partner of Raw Selection. Raw Selection is a private equity specialist executive search firm with two divisions, one that focuses on portfolio, C-suite executive hires, and one that focuses on private equity direct hires of the back office and investment deal professionals to the industry. Alongside the podcast, we're passionate about giving back to the industry and giving people information that they can run and utilize. One thing we do regularly every year is we run salary reports on accurate and live data of people that we've interviewed and people that have shared their information with us. So if you're looking to compare your current compensation or your compensation for your next hire in your private equity firm or portfolio company, then please check out our YouTube channel and see the playlist of salary surveys. Looking at Cresta, why did you choose to focus your investments around decarbonization?
Yeah. So with our background, three of the partners had a background in industrial gas, energy gas. So we understand methane and CO2 and sulfur gases and nitrogen gases. All of these components are greenhouse gases that are a problem. Our fourth partner has a long background in fuels and alternative fuels in particular. And so when we looked at decarbonization, we saw this big, long trend that's necessary just around, you know, sort of environmental mitigation that's just going to continue forever and ever and ever. I know there's a lot of debate right now about ESG. We can come back to that topic. But I don't think anyone's anti-environment. Everyone understands we want to protect the environment. And it's just a question of what's the cost. We didn't, when you look at where greenhouse gases come from, only a quarter to maybe a third come from the power sector, right? So the majority of, 3/4 of greenhouse gases come from other sectors. That can be ag, it can be waste, it can be industrials, or logistics. But it comes from sources other than power production. And that's really where our background was. We understand waste gas, we understand alternative fuels. We see these areas as sort of under invested relative to utility scale solar and wind. And it's an area that has a lot of growth left to come and a lot of earlier stage development. There's not a lot that's been built yet. So whatever's going to be built has yet to be built. And that's really where we like to spend our time and attention.
So you're working in with a green lens on the the dirty side, I suppose, that's usually positioned within private equity. How are you when people have a premise around decarbonization or impact and all these kind of elements? What tends to the kind of perception is, well, okay, how does this bring returns for LPs? So, how are you partnering your decarbonization focus and still producing the kind of private equity desired levels of returns?
Yeah, that's a great question. Yeah, so we are returns first, right? We're not an impact fund, but we do believe there's a big secular trend around focusing on environmental impact, and that's going to continue for a very, very long time. And so we see lots of ways to generate real value in that sector. The way we focus on it is, we call it pragmatic innovation. So we really think about the cost curve. And I think it's very important. It's kind of a lost part of the discussion is what is the cost of all of this, decarbonization that's going on? Because there are definitely things on the cost curve that are pretty steep and very inflationary, but there are other areas of the cost curve that really have minimal incremental cost to business as usual. And so what we've done is really focus all of our attention to the far left of the curve initially. Carbon capture is a good example. If you think about carbon capture, people will lump a lot of things into carbon capture. You'll hear things like direct air capture. Well, that's very expensive, right? It's a very expensive way to mitigate carbon. But you can also just hook a hose up to the back of a plant and bury the gas, right? So that's another type of carbon capture. Within that type of carbon capture, there's some solutions that are very low cost and some that are more expensive. What drives the difference in cost is, how pure the CO2 stream is that you're working with. If you're working with a company or a plant that produces a really pure grade of CO2 already, and that could be something like ammonia production for fertilizer, then it's actually very low cost to hook up to that pure grade of CO2 emission and bury it in, a well deep under the ground where it's never going to come back. It's a very low cost solution. I mean, single digit dollars per ton type solution. If you're dealing with CO2 that's blended into lots of other gases, so let's say the back of a power plant, where maybe only 4 or 5% of that exhaust stream is CO2, well, that's going to be very expensive because the first thing you have to do is tease that CO2 from those other gases. So again, we focus on the things that are to the far left of the curve with the idea that technology is helping bring those things that are further up the curve down by the day, right? We're seeing lots of new technologies for gas separation. If those become commercial, that could bring that power plant sort of into focus for us and make it commercial. But the way that we make returns is really to stay in that pragmatic side of the solution set. We're not looking at science projects. We're not looking at high tech, brand new pilot plants. We're looking at things that are pretty boring. They work. They have a high impact. They're pretty low cost.
A lot to be said for that. So the focus for you guys is to focus on infrastructure investments that have a lens that can be brought in with whether it be a technology lens or to literally reduce that carbon footprint, if you will.
That's right, and it's a big range of things. Like we're I would say four segments. We're in logistics, so that can be air and rail and trucking. And the reason we're in logistics is we don't think batteries are a great solution for all of transportation. Works fine for a short haul run back and forth to work, commuter vehicles, or last mile distribution. It's a lot more challenging for aviation just because of the weight of batteries. They tend to be very, very heavy.
Mm-hmm.
So we think, alternative fuels, there's technologies that can actually improve the fuel burn of an aircraft by changing the wing or the blade of the propeller or the turbofan. So there's lots of these kind of technologies. So it's not all just, fuels and carbon capture. There's a lot of really interesting efficiency gains to be had. So logistics is an area, waste is a big area of ours. I would kind of lump agriculture in there, and then industry and energy. Those are sort of our big areas. So within those, we're looking at ways to either create efficiency, mitigate carbon impact, or find a replacement of some sort that has no carbon impact. And so that's really our target area.
Interesting. It reminds me a bit of a story. It kind of has this lens, actually. Obviously many years ago, London had a big issue with horses going through centre of London. Obviously, horse poo everywhere. Your horse would die. Nobody could move it, and they put all these rules and regulations in that you couldn't let your horse poo in anywhere in the city. You also couldn't leave your horse to die because obviously nobody had the infrastructure to move it. And then the motor car was invented on a mass scale and solved the problem, and obviously moved the supply chain to a different level of challenge, but it's that kind of a premise of around we can create as many rules and regulations around these things, but technology is probably the one that's going to save us from there. And it sounds like you guys are using that lens within what most people are scared of with regards to, not scared is probably not the right word, but maybe haven't pushed into that investment theory around that, and you're basically looking to make these areas greener, more efficient, more productive, and therefore fundamentally improve EBITDAs to make them more obviously efficient and everything else that comes with it, I guess.
That's right. I think we see what we call it the missing middle. So there's a lot of capital raised in infrastructure, core infra, value-added infra,
Yeah.
and there's a lot of capital raised in climate tech, right? That's working on these new science experiments effectively. The middle, there's a big gap, right? So if you have something that's grown out of the venture capital world, it's
Hmm.
now commercial scale, it works, it's no longer a pilot program. We've got
Yeah.
lots of examples of it, but it still has to be built from scratch. There's not a lot of them already built. We have to go build them for individual customers, and
Okay.
it's relatively small per ticket. Maybe each installation of this new technology is 25 to $50 million. You have this big gap where it doesn't quite fit the big Brookfields of the world, but it doesn't really fit venture capital anymore. And that's what we're trying to approach is that bridge solution that is not tech forward, but it is development forward. We're willing to take the risk of building things out and get them to a certain scale where then those groups that are less development forward, it's more digestible for them.
Not only am I the host of the Private Equity Podcast, I'm also the founder and managing partner of Raw Selection. Raw Selection's an executive search firm working exclusively within the private equity industry, supporting the portfolio companies and the private equity firms with securing exceptional talent with our motto of de-risking executive search. So if I can ask and dive a little bit into the strategy. So once the acquisition has been made, you're obviously looking to invest in these companies, develop that technology, bring in different means. What's your exit process from there? What's your strategy in order to obviously drive value and grow? Because a lot of these companies will be, I know infrastructure doesn't typically play with a roll up type mentality or whatever else. So how does that play within your world?
Yeah, so what we see is I think it follows a bit of what we saw in energy shale development, where
Okay.
your initial years of energy shale was all independence, right? It was you didn't Exxon had left the United States. They were no longer onshore. They were offshore only. And you had all of these early, effectively startups that were building out and proving that shale was a real thing and that it could make money and that you could build out regional sort of platforms, if you will. And then you had this consolidation period where Exxon bought XTO, came back into the US. You also had different private equity firms. You had the earlier firms that were investing in these one-off developments, and then you
Hmm.
had a new wave of firms that were much bigger that were rolling these developments up and then going public. I think that's very similar to what we see in decarbonization today. You have a lot of smaller kind of independents that are trying to build out small platforms. And in some sectors that have been grinding away for a decade or more, biofuels is a good example. I think carbon capture is still a little on the earlier side of this, but it will eventually get
Hmm.
there. You're seeing moderately sized strategics emerge where strategics have been buying up the smaller platforms. You see this in renewable natural gas, for example, where a lot of these dairy farms were or
Okay.
landfill were built out on a project level basis, one landfill, one dairy farm. And now you have firms that have consolidated lots of those and become, more credit worthy and are building out more predictable cash flows. And with that comes an arbitrage. You now have less volatility, so a little higher multiple. And that's what we see, it's already happened to some degree in our Sustainable Fund One. And we think that will continue on where once we get, a handful of these smaller specific projects under one roof. Then we have a smaller sort of starter kit platform that could be bolted onto other platforms and build more of a mega platform. And that's where I think it's attractive to the large infra firms or other strategics. So we build everything with a strategic in mind. Our plan is to always build something that one of the majors needs to have. But what we're seeing more and more is as we de-risk, the contracts that we're looking at in our sector, these are 7 to 15 year fixed fee contracts in a lot of cases. They're very attractive contract structures. They are quite infra-like once built out. So we're seeing more and more, we're getting phone calls from the larger, real asset oriented or infrastructure oriented PE firms saying, hey, I've heard about this portfolio company you have. We're starting to look around in that area. Would you guys be interested in talking? And so I think that will continue. So we'll continue to always have the strategics in mind. But I would say over the next 5 years, I think the majority of our exits will be to larger firms that are platforming up kind of the types of assets we're building. We joke that, there's a lot of empty grocery store shelves right now, and but people with carts and big wallets, and they're just looking to buy stuff. And we just need to populate those shelves as quickly as we can with good product.
I like that analogy. So you referenced ESG earlier. Talk to us about your belief structure around environmental, social, and governance.
You bet. Yeah, I think that, it's been interesting the last few years, the sort of whipsaw effect that we've seen around ESG. And it feels like there's this sort of false distinction that's emerging where people are being asked to either be in camp climate denier or camp climate alarmist. There's no middle, and I personally don't believe there's anyone I've met that is anti-environment or anti-climate, and I just don't think that's a fair sort of position.
Yep.
And I also think that there are a lot of people, ourselves included, that understand the importance of conventional energy and how it plays a role in lowering sort of the economic costs around the globe for development. but also recognize there's an environmental impact to that. And I think most people sort of fit in that middle where no one wants to pay more at the pump for some abstract future good that they can't quite get their head around. I think the real debate needs to be around cost. So it's not that people are anti-climate, it's that they want to understand the cost of fixing this problem and what is the benefit to be gained from fixing this problem. And we don't talk about that a lot. I think a lot of people on the farthest left of this argument will say, well, I'll start with farthest right. The farthest right of the argument will say, there's not a problem. Climate change isn't real. It's made up, right? I don't think that that's credible, right? I don't think that science believes that. But on the far left, you'll hear, we need to fix this at any cost. It's existential. Like we're all going to die if we don't fix this problem. And if you really read the science, there's not a single credible climate scientist who's saying that either. No one says the planet's going to become uninhabitable due to global warming. What they're saying is that there are going to be a lot of excess deaths due to global warming in the next century if we don't figure out how to get it under control. It's going to be a lot of the most vulnerable groups due to food scarcity, due to heat waves, due to disease outbreaks. And they've even quantified that. They would say between now and the end of the century, there's roughly 100 million people are going to die if we don't solve climate change. It's a big number. But if you look at that and you look at other areas where we have problems we should be addressing, and let's take the top three treatable diseases in the planet right now. And tuberculosis, malaria, HIV. Those three diseases kill 2.5 million people a year, which is 180 million people by the end of the century if we don't eradicate those, right? So it's not that climate change isn't a problem, it's that putting all resources to that problem would take resources from other problems. We need to be approaching this more holistically. We obviously believe that solving climate change is a real issue and something we have to focus on. It's a huge part of our company culture. But we also recognize it has to be done in a way that doesn't create cost inflation that could otherwise hurt the most vulnerable populations on the planet, right? If you have food scarcity due to energy cost, that could be just as bad or worse than the impact from climate change. So we want this debate to really be around cost and benefit and not around which camp you're in. You don't have to be in Camp Exxon or Camp Greenpeace. You can be somewhere in the middle. And we think most people are, in fact, and we'd rather have that discussion around pragmatic, low-cost solutions than around, Camp A or Camp B.
Appreciate that. Good, pragmatic approach. What are your influences? What do you read, watch, listen to that you would recommend that others check out?
Yeah, well, I think I don't listen to a lot of current events to start with. I do listen to a couple of podcasts that I find fascinating. I guess it comes from having been a founder at one point. I do listen to the Founders Podcast occasionally, which I think is pretty fascinating. It's effectively a 1 hour condensed read of a biography of some great founder with the idea of pulling out lessons that are timeless and that can sort of be applied to lots of different applications. Another one I really like, I don't listen to it often, but I always enjoy it, is the Acquired podcast. It's one that's, again, focused on it started more tech forward, but now they've really approached a lot of different businesses, and it's same thing, following founders and how they develop over time. I also listen to a lot of philosophy podcasts. I read a lot of Stoicism. I think that probably informs. I think I keep a copy of Meditations in my briefcase and pop it open from time to time. There's always good wisdom there. That informs a lot of how I approach private equity, which is this idea that we ultimately can't control the external events in our lives. We like to think we can. We form plans, we build forecasts, but we have to know in our hearts that those forecasts are going to be wrong, right? The best thing they can do is give us a head start to addressing what actually shows up, whatever that is. But the real key, I think, to Stoicism is remembering that we can't control the event, we can control our reaction, right? And so as long as we stay focused on, here's the truth, this is what's brutally honest and real, and this is how we're going to address it, I think we can avoid a lot of the problems that plague companies where I've been in meetings where I'm sure you have as well. Something goes wrong. The first half of the meeting is, whose fault is this, right? And I think that is so unnecessary, right? What we need to do is just figure out how to address what we're faced with every minute
Yeah.
and not worry so much about, but I thought it was going to go this way. It didn't. And now I'm really, really upset that it didn't go the way I thought. So
Absolutely. Absolutely. And Chris, if anybody wishes to reach out to you post this podcast, how best do they do so, please?
yeah, the best way is just info@crestafunds.com. That goes straight to me as well as to a few other folks so that if I happen to miss it, someone else will see it. And we're monitoring that every day. So we'd love to hear from anyone that is interested in what we do and any way we can help out. So,
Perfect. Well, thank you very much for coming on the podcast, giving us a pragmatic approach to ESG, which is always nice to hear, but also your lens and your focus on private equity, but also a bit into your journey. So appreciate you coming on the podcast and thank you very much.
thank you, Alex. Really appreciate it.
And as always, thank you very much for everybody for tuning in yet again to the Private Equity Podcast. If you've not done so already, please do subscribe and you'll be notified of the podcast that comes out every single week. But till the next time, keep smashing it. And thank you very much for listening.